What if I told you builders are walking away from projects in markets where prices are falling? Sounds backwards, right? But HUD's reality check says 8.46 millions. Very low-income renter households still face worst-case needs, while new units land out of reach. In this countdown, 10 cities show the affordability paradox in plain sight. Rates near 6% won't save you when the only viable pro forma is luxury. Stick around, and I'll reveal which markets eased supply, lost buyers, and still can't sell the cheap stuff. You're not ready for number 3. Before we move on, please take a moment to subscribe to the channel and like the video. Number 1, San Francisco, California. How do you have cranes in the sky and still no buyers? In San Francisco, your starter comes with a doorman, marble, and a monthly that eats your soul. Entry level is luxury with a beard. Let that sink in. Here's the thing. Post-pandemic, downtown emptied out at lunch hour, but the cost to build never came back to earth. Steel, labor, seismic, entitlement drag, none of it discounted. So developers only greenlight projects that can charge premium numbers, because anything mid-tier blows up the spreadsheet the second you add carrying costs. Rates drifting toward the 6s tease people back into open houses, sure. But then the stack hits. HOA fees that rival a car payment, city taxes, special assessments, and build economics in the $800 to $1,200 per square foot range. You need either a bonus-heavy income or straight cash. Most buyers? They run the numbers on a napkin and ghost the sales team. Walk through Soma and you'll catch it live. One condo tower topped out, wrapped, and suddenly silence. Another glossy project half sold, offering free storage, a year of HOA, even unit upgrades just to move a handful more. Behind the scenes, a lender tightens the draw schedule and whispers about pre-sale thresholds. If velocity slows, money slows. It's real. It's happening. Inventory at the high end creeps up. Class A lease-ups take longer, with weeks of concessions replacing last cycle's waitlists. And here's the kicker. The pro forma only flies if units clear a premium mark. Dip below that line to spark demand, and you blow covenants, ding valuations, and trigger those lovely remedial calls. Nobody wants that phone call. So the city talks about converting offices to apartments like it's a cheat code. But here's the catch. Conversion costs are still steep. You're gutting floor plates, chasing natural light, redoing cores, adding plumbing stacks, and upgrading life safety. By the time you finish, you still need high rents to make the math close. True affordability never shows up at the closing table. Meanwhile, HUD's reality check bites. Extremely low-income renters face the gnarliest gaps, and the pipeline here doesn't touch them. A light HTC trickles help a sliver, but the bulk of new doors land far above what the hardest-hit households can handle. It's like offering caviar when the line needs rice. So who's the buyer when the cheap version still tags at $900,000 with a 4-figure HOA? The pool shrinks to equity-comped tech vets, trust fund kids, and the rare downsizer who doesn't blink. Everyone else rents longer or leaves. Mini payoff time. Projects go dark not because demand vanished, but because dropping prices to clear inventory trips lender covenants and nukes equity. Better to mothball than sell at a loss. And if discounted luxury can't move in San Francisco, wait till land costs meet sprawl math down south. Number 2, Los Angeles, California. LA has approvals on paper and tumbleweeds on the lots. Why? Because the spreadsheet screams, nope. You can hold a stamped permit like a golden ticket and still not pour a yard of concrete. That's the vibe. Let's break it down. The trifecta does the damage. Impact fees stack early, inclusionary requirements pull revenue out of the mix, and labor keeps climbing. Each one lifts the floor price before you even buy a sink. By the time you add seismic, parking mandates, and utility hookups, your starter budget looks like a luxury audition. And yet everyone thinks 2026 mortgage relief fixes it. Cute. You still have the monthly to beat. Principal and interest plus insurance that jumped, HOAs that read like a gym membership you don't use, and parking rents that act like a second bill. The paycheck loses. The model dies quietly in a tab on someone's laptop. Real world. A 6/1 in Koreatown gets through design, start scheduling trades, and then the subcontractor bids land 18% above estimate. Doors close, site fence stays up, carry burns while the owner rewrites scopes and prays the electrician trims a digit. Months pass, nothing moves. This is where the research reality kicks in. Typical LA hard costs and soft costs hit from both sides, while time to permit delays kill carry. You bleed interest waiting on reviews, then you bleed more while appeals drag. It's death by calendar. Pro formas in this city are beyond sensitive. A 5% rent haircut kills your year 1 yield. A 50 basis point rate bump shreds your coverage. You don't need a recession to sink it. Just one slow lease up or a nervous lender. And lenders are nervous. They want pre-sales, stronger guarantees, and proof you can exit in one piece. Here's the catch that makes everyone mad. Those affordable set-asides don't reach very low-income or extremely low-income households without deep subsidies. QD's 2025 reality check says for every 100 ELI renter households, there were only 65.8 affordable rentals, 38.4 that were both affordable and available, and just 33.7 that were affordable, available, and physically adequate. That gap is a canyon. Your building doesn't bridge it with a handful of units and a ribbon cutting. Even with density bonuses, the math rarely clears unless you tack on high-end finishes to push rents or prices. It's backwards, but land and construction costs force your hand. Stainless buys yield, vinyl kills it. So teams add amenity decks and quartz just to keep the lender calm. Mini payoff. Developers walk to protect equity, lenders freeze draws until pre-sales improve, and sites idle. Crews move on, schedules die. And since the fix won't come from shinier kitchens, watch what happens when the city built on tech demand learns the demand rewrote itself. Number 3, Seattle, Washington. Seattle built for infinite tech demand. Then infinite cut back to hybrid, and underwriting blinked. You felt it the second office badges stopped pinging 5 days a week. The buy button got shy. The build button, too. New supply is still hitting the market while leasing softens. Landlords throw weeks free, parking credits, even pet rent forgiveness just to juice traffic. Downtown's recovery lags, which means those fresh units stare at each other across empty corridors. The vibe is polished and quiet. Here's the thing. Construction costs locked in during the inflation spike and never came down. Concrete, glazing, MEP, sticky. So rents and condo prices would need FFANG-era growth to keep pace, and that era left for Teams calls and Slack threads. The result is a spread that devours projects whole. You see the panic move. A tower that launched as for sale condos pivots to rentals, hoping faster absorption saves the day. Then lease-up math misses debt coverage anyway, and the crane slows to a crawl. Amenity packages get value engineered. Delivery dates slide. The lender smiles politely and waits. Recent rent growth is flat compared to the 2021 to 2022 spikes you remember. Concessions rise and renewal increases lose their fangs. Meanwhile, the construction bid you pulled in 2022 still elevated. Subs aren't cutting numbers because pipeline risk is theirs now too. Everyone is guarding margin like it's an iPhone with 2% battery left. Remote work shaved the premium off core addresses. If your boss is fine with 2 days in, why pay downtown rates for a studio with a view of another studio? Buyers chase space to price in the suburbs, swap elevator waits for garages, and keep a second bedroom for Zoom. That migration drains the pool for micro units that used to sell on Vibe alone. HODI's data backs the squeeze at the bottom. Very low-income renters face a persistent shortage of affordable and available homes. The West alone carried 2.29 million households with worst-case needs. And the wild part? Naturally affordable stock gets up-filtered by higher earners who can't or won't buy, shrinking options for the people who need them most. That's the affordability paradox live on stage. So if value buyers left downtown, who closes on the micro units and the efficiency floors? Not the hybrid worker with a car, not the family counting daycare costs. The audience gets smaller and the show gets pricey. Mini payoff. Teams resequence phases, cut amenities that don't move NOI or just walk. Equity shifts towards suburban build-to-rent where land is cheaper, parking is easy, and lease-ups don't depend on a latte downstairs. Speaking of tech money, San Jose has the income, just not the price-to-income ratio that normal humans can swallow. Number 4, San Jose, California. In San Jose, median incomes flex, but they still tap out when a starter wants a 7-figure sticker and rents hover at $4 a foot. You can clear 6 figures and still fail the entry exam. That's the market telling you who gets the keys. Here's the thing. Land is scarce, sites are tight, and entitlement friction chews months while interest carries the tab. By the time you fight through review cycles, neighbors, and design tweaks, your only viable path is high-spec. Tech-adjacent buyers expect smart systems, solid acoustics, and finishes that don't scream starter. That spec raises costs before you've even poured the slab. Rates easing teases headlines, but the down payment is still a Tesla. 20% on a $1 million townhome is a life decision, not a weekend errand. Liquidity dries up for first-time buyers who need help from savings, family, or RSUS that don't time the market. The pre-approval looks fine until the underwriter adds HOA insurance and taxes. Now the monthly flares red. Walk by a topped-out townhome stack and you feel it. Sales center open. Balloons out. Crickets. Pre-sales stall as buyers hit debt-to-income walls after the HOA gets priced in, and the insurer drops a number that eats the grocery budget. Lenders want clean DTIS. Calculators say no. Units sit staged and lonely. Price-to-income ratios here run hot enough to melt the vibe. Even with a strong paycheck, the stack is brutal. Mortgage, HOA that pays for elevators and common systems, and insurance that climbed. Each line item nudges the monthly out of comfort range. One small bump, and the deal dies. That's before parking or any special assessment talk. Yes, LIHTC units help, and they do place a few households. But inventory is thin, demand is massive, and the queue never ends. Very low-income and extremely low-income households need vouchers to bridge the gap. And even then, the available doors don't match the need. It's triage, not scale. So the paradox stands. Only luxury pencils on the pro forma, but luxury doesn't sell at the volume that fixes demand. You can add quartz, a rooftop, and a fitness room. Can't conjure 1,000 qualified buyers at once. Sales velocity crawls. Carry burns. Everyone smiles through clenched teeth. Now ask the scary question. What happens when high earners rent longer? Builders lose the exit. Projects that counted on quick closings pivot to lease and hold, or they punt. Equity that wanted a for-sale pop picks steady rent checks instead. Mini payoff, a developer shifts the plan to a long-term rental hold or sells the dirt to reset basis. The cranes wait. The math breathes. Let's fly to Austin where the hype train slowed and raw carrying costs stepped out from behind the curtain. Number 5. Austin, Texas. Austin was the poster child of build everywhere. Then listings grew and buyers ghosted the finish line. Open houses had snacks. Closings didn't show it. Here's the thing. Inventory climbed. Price cuts looked polite, but construction debt got heavier, and tax assessments spiked operating costs. Carry isn't theoretical, it hits every month. Builders can shave a sticker, but they can't dodge interest, taxes, and the line items that make accountants sweat. Entry-level buyers keep getting priced out by the boring stuff. Property taxes chew the escrow. Insurance climbs. New construction HOAs creep higher to fund gates, pools, and landscaping that looked great in a render. The monthly turns into a brick. You don't feel it on the tour, you feel it when the lender emails the truth. Out in the burbs, master-planned communities tap the brakes. Phases get smaller. Amenity centers slide to future improvement. Trails and splash pads wait for the next cycle. Sales teams pitch 2-to-1 buy-downs, and they help at first, but year 3 shows up and the payment jumps. The deal dissolves in the fine print. Cancellations tell the story better than any billboard. When new home cancellation rates rise, it's buyers doing the math and walking. Pair that with insurance hikes and those Texas-sized property tax bills, and affordability collapses in slow motion. The house didn't change. The monthly did. Why do starter homes come with quartz, smart locks, and a garage epoxy? Because the resale across the street already has shade trees, a settled tax value, and no construction noise. To compete, the new build needs sizzle. Sizzle costs money. You can't fight a mature neighborhood with laminate and base-grade lights and expect traffic to convert. HUD data puts a sharper edge on the problem. Worst-case renter needs are rising as households form, and the new supply doesn't meet the bottom of the market. That's the paradox in Austin. Production exists, but not at the price band where the struggle lives. You can add units all day. If none hit the target, the gap widens. Investors see it too. Rents flatten, cap rates drift up, and the exit looks fuzzy. The spreadsheet used to promise a clean flip to a buyer or a refi. Now the yield spreads look thin, and the appetite cools. Even the buy 5, rent forever crowd checks out when taxes and insurance eat the margin. Mini payoff. Developers shelve phases, hold cash, and wait. Selling at a loss is option. Waiting for cost to normalize is a strategy. Crews shift, dirt sits, and the sign says, coming soon, longer than planned. Houston builds fast and cheap, but cheap isn't cheap enough anymore. Number 6, Houston, Texas. Houston can outbuild almost anyone, but when margins evaporate, even volume guys tap the brakes. That's the tell. You can crank out rooftops all day until the math throws a flag and the bank stops clapping. Here's the thing. For years, abundant land and the light touch zoning vibe kept entry prices in check. Then materials crept up and never fully came back. Insurance premiums spiked, and financing costs punched the carry. Low sticker prices only worked when everything else was cheap. Now every line item wants a raise. Rates dip a bit, and model homes get weekend traffic. You feel a demand bump, but the entry-level buyer still misses the income bar when you stack principal, interest, taxes, insurance, and the HOA needed to mow those long medians. The monthly wins the fight. The pre-approval loses. So starter communities start shrinking to survive. Smaller lots, narrower elevations, 2 baths instead of 2.5. Granite becomes builder-grade solid surface. You trim the landscaping package and push the community pool to phase 3. Even then, buyers stare at the payment and back away. Cheaper? Still isn't cheap. Construction inflation has a lag that bites late. Builders ink a price on lumber and HVAC today and get hit by revised bids months later. That delay injects guesswork into every budget. Stack that with insurer retrenchment in storm-exposed zones. Premium quotes jump, deductibles swell, and the cost to own climbs before anyone hangs a wreath on the front door. It's like chasing a sale on an iPhone. Then the carrier slaps on fees at checkout. Lender appetite shifts with absorption. When spec homes sit longer, the construction lenders tighten. Lower advance rates, higher spreads, more interest reserve. Some want pre-sales on floor plans that used to fly without them. If traffic slows for a quarter, your borrowing base does too. That's not theoretical, that's a redlined draw request. HUD's numbers make the gap feel brick solid. Per 100 extremely low-income renter households, there are only 38.4 affordable and available rentals. For very low income, it's 58.8. So-called market rate, affordable product doesn't land anywhere near those households. Without deep subsidy, the bottom never shows up to closing. The pipeline misses the people who need it. And if Houston can't make cheap work at scale, what does that say about the broader Sunbelt model that banks on land and speed? You're not ready for that answer. Mini payoff. Teams pause mid-platting rather than force bad paper. Builders bank land, keep options alive, and wait for inputs to cool. Dirt holds. Crews redeploy. Sales flags come down until costs blink. Phoenix tried the build-to-rent shortcut, then operating math hit a wall. Number 7, Phoenix, Arizona. Phoenix leaned into build-to-rent like it was a cheat code. Then rent growth cooled and cap rates widened. The spread that used to make bankers nod now makes them stare at their shoes. Let that sink in. Here's the thing. A flood of new single-family rental communities and garden apartments hit at the same time. Absorption softened. Leasing offices offer a week or two free, then 4, and now they're handing out credits for garages and pets just to move the line. Supply is landing. Demand is picky. Traffic tours, asks about specials, and leaves. Operating costs climbed while the rent ladder got short. Taxes adjust higher with new valuations. Insurance premiums jumped. Utilities for detached units, landscaping, water, individual HVAC loads, push OPEX up. Concessions slice the top line. Net effective rent slips even when the sticker looks steady. Yield gets squeezed from both sides. You can see the crack in a single deal. A BTR community finds a buyer, sails through due diligence, and loses them at closing when the lender reprices the debt. The takeout cap moved. The refi penciled with a rate spread that wipes out returns. One line in the model turns red, and the exit evaporate. The data trend backs the vibe. Phoenix rent growth eased from the spike years, concessions ticked up as deliveries stacked, multifamily cap rates expanded, and SFR rental trades followed with wider yields demanded by buyers. That shift matters. A 100 to 150 basis point move on the exit cap takes a clean merchant build into "why are we doing this?" territory, especially when construction costs never really rolled back. Let's break the stack. Merchant builders raise equity, borrow construction, lease to 90 plus, then sell at a target cap. If the exit cap expands by a full point, you don't nick the profit. You cut it in half, or worse. Add slower lease up and a few months of freebies, and your interest reserve gets thin. The model wants yesterday's pricing. Yesterday left. So sponsors freeze starts. They hunt for JV capital with a longer hold or pivot to partial phasing. Meanwhile, renters still can't afford ownership. Mortgage rates near the mid-6s don't fix down payments or HOA plus insurance plus taxes. The paradox persists. Renters can't buy, builders can't exit. If renters can't buy and investors won't buy, who's left? You get a smaller pool of value-add funds circling only if the discount is loud. Everyone else waits for distress. Mini payoff. Projects walk, land gets relisted, and only deeply discounted deals move. Phoenix went from cheat code to pop quiz fast, and the grade curve isn't friendly. Las Vegas rides booms. This time the hangover came early. Number 8, Las Vegas, Nevada. Vegas rolled out the buffet, upgrades, rate buydowns, even free appliances. Sales centers looked generous. Buyers still flinched. Because when the monthly hits, the fridge isn't the problem. The payment is. Here's the thing. Tourism came back, casinos rehired, service jobs refilled, but wages didn't outrun the new cost stack. First-time buyers stare at the PTI plus HOA plus insurance number and tap out. The city feels busy again, yet entry buyers can't clear the bar. Let that sink in. Resale homes are the silent assassin. Sellers cut prices and toss in closing costs. New builds can't match without torching margin. Then appraisals come in light, and the lender side-eyes the whole deal. You get the classic Vegas two-step. Buyer qualifies on paper, appraisal dings value, and now you're renegotiating while the rate lock ticks. Lenders get jumpy when enough files read value short. So master-planned communities stretch timelines. Phases slip. Amenity centers slide from grand opening this fall to coming later, because cutting burn beats cutting price. Builders keep the lights on with smaller releases and fewer models, hoping the interest list gets stronger before the next draw. The data trail lines up with what you feel on the ground. Appraisal gaps show up more often when incentives mask the real value. Incentives spread across the valley. Rate buy-downs, appliance packages, upgrades. Yet conversion stays weak, and wage growth trails the jump in monthly housing costs. That mismatch crushes entry demand no matter how many stainless bundles you promise. Here's the catch most folks miss. The HOA isn't a line item, it's a second rent. Then you see district charges that act like mellow roofs layered on top in certain zones. Stack mortgage, insurance, HOA, and those special assessments, and the deal evaporates. Insurance doesn't need a hurricane to move. Regional repricing alone can nudge premiums and deductibles up enough to wreck the budget. Zoom out, and the affordability hole gets deeper. HUD's latest read shows the West with 2.29 million very low-income renters facing worst-case needs. Vegas isn't a carve-out. That shortage means the bottom of the market never meets the new home price, which is why incentives feel like coupons for a car you weren't buying anyway. So, if the Fun City can't sell a discount, something deeper is broken. The math, not the marketing, drives the traffic. When the spreadsheet screams, the balloons outside don't matter. Mini payoff. Builders wait for better qualified leads, investors demand louder price cuts, and projects idle rather than bleed. Crews move to where the checks clear. Florida was supposed to be the discount. Orlando just discounted into a brick wall. Number 9. Orlando, Florida. Florida got the headlines. Price drops. Orlando cut stickers and buyers still walked. Sounds like a clearance sale, right? But the deal dies when the monthly shows up with extra friends. Here's the thing. Insurance spiked. HOAs crept. Hurricane risk premiums slid into quotes like hidden resort fees. That wipes out the savings from a list cut. You can slice 10, 20 grand off the top, and the escrow still balloons. The lender doesn't care about your new backsplash. They care about the all-in monthly. Inventory keeps rising, so builders try everything. You see 3-2-1 buy-downs on banners and sales reps promising your first year feels easy. Some pockets post double-digit list cuts. It looks like momentum. It's really a tug-of-war with arithmetic. Buyers tour, nod, and then stare at the estimate sheet until the smile fades. Take a townhome tract off 417. They shaved 40 grand off the sticker, and you think you scored. Then closing costs roll in heavy, wind coverage quotes land like a kettlebell, and the HOA reads like a luxury gym. The win evaporates by the time you hit DocuSign. The monthly sits where it started, sometimes higher once the teaser wears off. Forecasts back the vibe. Analyses tied to Realtor.com show 7 of Florida's 8 biggest cities set up for 2026 price declines, with other metros in the state posting eye-catching drop estimates. CBS covered those projections, which put Florida on the front row for softening. But here's the catch. Insurance trends are going the opposite way. Premiums have been repriced higher, and fees keep climbing. That combo turns a price cut into a headline, not a solution. Even after markdowns, the median household can't reach the bar. The payment stack wins, taxes recalibrate, HOAs bake in storm reserves and amenities maintenance. Insurance adds wind and flood riders that bite. So affordability stays out of reach for the people actually trying to buy a first home. While the listing sheets flex, reduced like it matters. Zoom out, and the bottom looks worse. QD says there are only 38.4 affordable and available rentals per 100 extremely low-income renters nationwide. That's a canyon. Orlando's new stock isn't aimed at that group. It's geared to buyers with clean files and room to absorb volatility. So the folks with the biggest needs stay renters, and the new build pipeline misses them entirely. Discounts can't fix a broken PT plus HOA reality. If the escrow is ugly, the price tag is just set dressing. That's why you see temporary pause signs where there should be ribbon cuttings. Mini payoff. Developers wait on insurance reform or fresh subsidies, and some scrap entire phases rather than bleed cash into a storm. Crews slide to safer bets while interest lists get audited. Atlanta has jobs and migration, but entry-level product? Still. MIA. Number 10, Atlanta, Georgia. Atlanta's job machine is strong, yet first-time buyers are stuck in traffic behind construction signs that never move. You can have a promotion, a parking spot, and still get smoked by the payment. That's the punchline. Here's the thing. Land is cheaper than the coast, but not cheap enough to cancel out pricier materials, higher labor, and fatter financing costs. Lumber didn't roll back to pre-pandemic. Trades want more, and the carry racks up while permits meander. Add the boring killers, property taxes, insurance, and HOAS that fund those shiny suburban entrances. And your affordable turns into a second car note, plus a gym membership you didn't ask for. Then Build to Rent shows up and changes the draft board. BTR groups bid on entire pods, close fast, and underwrite to rents, not mortgages. They can pay more for dirt because their exit is a stabilized yield, not a line of nervous first-time buyers. That siphons lots straight out of the starter pipeline, and the remaining for sale deals can't compete on monthly cost once you stack pity, HOA, and insurance. You see it midstream, a subdivision that launched as for sale flips half the map to rentals after pre-sales drag. The rest of the for sale lots get plastic on the signs and a new phrase, future phase. Crews pivot to finish the rental streets. Sales flags come down. Carry stops bleeding. It's not drama, it's triage. Forecasts call for more inventory and a little rate relief. Cute. Debt to income still trips alarms because the total monthly didn't chill. A quarter point here, a modest price cut there, and the lender's software still flashes red. DTI wins those fights. The dream loses by a decimal. That's it for today. Don't forget to like and subscribe to the channel for more of the latest updates.